Most traders consistently lose money because they take random setups thinking that more trades equals more money, but that can't be further from the truth. Today, I'm going to show you exactly how to filter out the noise and focus only on high probability trades that actually make money. I'm going to show you the difference between taking high quality trade setups versus chasing random trades that have no basis in reality, have no mathematical basis at all, and yet you believe for some unknown reason that you actually have any chance of making money on the trade. In this lesson, I'm going to break down the exact process to spot this kind of trade, which can be executed every single day, and the crucial step to make sure that you're only entering the highest probability trades that give you a super high chance of winning the trade. Okay, now before we get into this option strategy, we're going to be teaching you in today's video. If you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. So if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so for those of you who are fairly new to trading, you probably don't realize how lucky you have it, because back in the day, options traders, and I'm not kidding you, only had one expiration per month that they could trade. Virtually every stock or index at most had one options chain expiring every month, just one a month. Now, if you fast forward to today, there are a growing number of options chains that expire not only once a month, but every single day. And so that changes everything, because what that means is that options traders can now develop simple trade plans that they can trade every single day. And by the end of each day, you'll know the exact outcome of your trade, which means that you can basically get 250 bites at the apple every year, because the market's open about 250 days a year on average. And so if you have a simple system that makes just a little bit every day, by the time the end of the year rolls around, your returns can actually be potentially huge. I mean, just think about it. If you develop a trading system that on $10,000 of trading makes on average just $20 a day, after 250 trading days, that translates into $5,000 or a 50% return on $10,000. That's incredible. And this opportunity just didn't exist before in the old days of options trading. And so that's why I say you don't know just how lucky you've got it being trading in this era. Okay, so the purpose of this video is to show you an example of how you could take advantage of this era of daily options expirations. And so the very first step is to pick a technical indicator which you're comfortable with. And so just as an example, and we're not suggesting you use this particular indicator one way or the other, that's up to you. But many professional traders do pay a lot of attention to a particular indicator known as VWAP, which stands for Volume Weighted Average Price. And VWAP is basically a measurement of the average price at which most of the shares that day have gotten transacted so far. And it's a weighted average. So that particular price that had a lot of shares traded at that exact price is going to get a greater weight than the prices that only had a few shares transacted again at that particular price, which is why, if you think about it, the way you establish the VWAP at any given moment in the market is to take the total number of dollars traded on that stock that day and divide it by the total number of shares traded that day. And that simple calculation is going to give you the VWAP at that moment, which of course changes throughout the day as the stock keeps trading and prices are moving around. And so when a stock is trading above its VWAP, then traders tend to consider the bulls to be in control, and therefore stock trading above VWAP is considered to be a bullish sign. Whereas if the price of the stock is trading below its VWAP, then that's generally considered to be a bearish sign at that moment, all other things being equal. And so let's say that you had chosen VWAP as your indicator, and you decided that you wanted to make an options trade on SPY every day. And SPY, of course, is the ETF that basically mirrors the basket of stocks contained in the S&P 500. And you had decided to use VWAP as your indicator of bullishness or bearishness. Okay, so let's head back to early in November, on November 5th at 10 a.m. in the morning. And as you can see, with SPY trading at 67.03 that morning, that the stock is trading well above VWAP at that hour. And so we're going to take this as a bullish sign. And so our second step is to sell what's called a 20 delta put option on bullish days. So that's what we're going to do today. Or on bearish days, we're going to sell a 20 delta call option. You're probably wondering what I mean by a 20 delta put or call option. And so hang in there because it's going to become crystal clear to you in a minute. Okay, so to clarify this for you, we're going to pull up today's options chain, which in this case would be the November 5th options chain, meaning that all of the options on that chain will expire at the end of that day, November 5th. And as you can see, there's a column on there labeled Delta. Do you see that on the options chain? Well, that's a really important column. And in fact, that's our secret sauce to this entire trading strategy, because an options delta is a very important number. You see, an options delta tells you how much the value of that option is going to change depending upon how much the stock moves. But there's an even more interesting property of an options delta, which is actually the key to this strategy. And that is that an options delta has also been found statistically to be the probability that the option is going to have any value at all by the end of the day when it expires. And so, for example, that put option we're pointing to on this slide, that 673 put option, has a delta, as you can see, of 18.61, which means that there's an 18.61% chance that that option will have value when it expires, which also means that there's an 81.39% chance that the put option will expire with no value. And as you know, a put option only has value if the stock closes below its strike price on the day it expires, because that gives the put owner the value of being able to sell his shares at a higher price than the current market price of the stock. So that's a valuable right. But if the stock closes above the put strike price on the day it expires, then that option is worthless. And the one who sold the put just gets to keep the cash he received for selling it in the first place. And the put option just expires and goes away. So if there's a greater than 80% chance that an option that we just sold will expire worthless, well, then we're going to actually win that trade because we got paid cash up front for selling that put, but we don't have any obligation to buy shares once the option expires. And so now you can understand why we pick a put option to sell, which actually has a high probability of losing all of its value by the time that it expires. That way, we just get to keep the cash we got for selling it in the first place. Okay, so now let's move on to the third and final step, and that is to buy a put below the put we sold if it was a bullish day, or buy a call above the call we sold if it's a bearish day. So let's look at an example of that on the same day where SPY is trading above VWAP, and so we're bullish, and we sold those 10 puts at 673, and in this case, our third and final step is to buy 10 672 puts for protection. And the reason why we say it serves as protection is that if SPY somehow really sells off anyway, despite trading above VWAP at 10 a.m., if that were to happen and close at, say, 660, then we'd be required to buy 100 shares of SPY for each put we sold, so 1,000 shares of SPY at 673 when the stock is trading at 660, way below where we'll be required to buy the shares. And so buying the 672 put protects our position, because if we're required to buy them at 673, then we can turn right around and sell them at 672, which means that we only suffer a minimal loss. In other words, the 672 puts that we buy are hedging our position and protecting our accounts. And so when we turn to the cash flow that we've just generated, as you can see, we sold the 673 puts for 47 cents, and each option represents 100 shares of stock. And so you multiply that by 100, and we sold 10 of them, which results in total cash inflow from those puts in the amount of 470. And using that same kind of calculation, we spend $360 on the protective puts, which nets us $110 in net cash. And please note that your broker is going to require $890 in capital in your account to make this trade, which is the trade's worst case scenario loss. Okay, so now let's move to the end of that day. And as you can see, SPY actually sold off that day towards the end of the day. and in the final few minutes of the market actually dropped below VWAP, closing at 677.54. So how did our trade come out? Well, the 673 put closed more than 4 points below where SPY closed, and the 672 put closed down even further below that SPY closing price. And so, as we mentioned, that means both options expired worthless, and so we just get to pocket the $110 that we received in the first place earlier that day. And that makes sense, right? Because even though SPY had a late day sell-off, it still closed above where it was when we opened our trade. And with puts located so far below where SPY was trading, when we opened the trade, we sold it so far down that there was about an 80% chance of the puts expiring worthless anyway. And so as you can see, statistically, we had a really good chance of winning this trade from the beginning, just based on probabilities. So let's move on to another example, and that is the very next day on November 6th. And as you can see on this day, the SPY is trading at 673.64 that day and noticeably below VWAP. And so remember, on bearish trades, we do just the opposite. We're going to sell a call with a delta no higher than 20, which in this case is the 16 delta call at 677, which sells for 39 cents. And so we'd sell 10 of those, and then we buy 10 of the calls up at 678, which are selling for 25 cents, turning the trade into a call credit spread this time because we bought that long call at 678, which is the protection against SPY rallying hard, just like we bought protection against the SPY selling off in the put credit spread example. And so using that same kind of calculation as before, you can see that our net positive cash flow this time is $140, which goes straight into our account and raises the cash balance in our account. And so when we move to the end of the day, you can see that SPY continued to sell off throughout the day, closing below VWAP down at 670.27. And so this was an easy win because we sold the call spread far above where the stock was trading, and it fell even further during the day, again closing down at 670.27. And so if we look at the settlement value of the call spread, you can see that both calls expired way above where SPY closed, rendering them both worthless. So again, the outcome is a full win, pocketing the full $140 that day. And so what I'd like you to take away from today's video is that with SPY options, there absolutely is a way to make a directional trade every day using SPY options, which have an expiration every day. And therefore, you'll know whether you've won or lost the trade that very same day. And if you've won, you'll see your account go up by the exact same amount of cash that you received. And on top of that, by selling puts on bullish days or selling calls on bearish days, protected of course, making them put spreads or call spreads, but locating them at a price where the short option is 80% or more likely to result in a win for you, which is the 20 delta option or less, I think you can easily understand why options traders are so attracted to selling lower delta option spreads. I mean, think of the room for error you have. Even if your indicator's lousy, you start out with an 80% chance of winning the trade. And if your indicator's reliable, whatever it may be, then your strategy should have an even higher win rate. Professional options traders, like the guys here at SMB, are trained to understand the probabilities of options trading strategies. And now we just walk you through, step by step, how you can take advantage of them as well.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.